All right, looks like we're live. You good? All right. Just one. All right, yeah, so we were talking a little bit before I went live here about indicators. And one of the things that I haven't really pointed out much lately or talked about is the put-call ratio. So I know a lot of guys that actually trade like just based off of put-call ratio, and I'll just clean up this chart here. But I know this is a little messy, but if you look on the left side here, this is the value of the put-call. And going back to last August, we had a low of about 0.32. And since then, we really haven't taken that out. But the put call has been a very reliable indicator over the last year of even shallow corrections. So we see we even got down to close to 3.2 here in January. And then kind of hit that double bottom here in February. We had that turbulence. And March was a little bit of a choppy period, but lesser correction. And then even recently, we got down, about 0.33, 0.34 in middle of June. And that kind of preceded this little correction. But we haven't really matched that low here of last August, September. And I think so when I keep talking about this blow off top that I'm talking about, I think the PCRI, the put call ratio, is really kind of the last indicator that hasn't fully flashed. But we talked about like the skew index. If we look at the skew, which is like the, basically the longer term volatility of the VIX, like this is pretty much at all-time highs. That's pretty ridiculous, right? So, but there's all these indicators that are flashing warning signs, and none of them have really triggered yet. Like you have to just tip your cap to Jerome Powell, I guess. But again, with yields, I think this is going to be the catalyst. And again, you look at the monthly here, it took us 4 months to really break down, and you have this 3-bar surge here. And now we're putting this consolidation pattern. Well, if we consolidate another month into July, and maybe we even retrace down to the 382 at about 1250 or 1.25 on the 10-year, and that would line up pretty much perfectly there, symmetrically, and that would line up with the Fed's Jackson Hole meeting. So really I'm looking for, at this point, that part of the reason this, factored into why I went long Apple today, because I don't want to get caught stuck in these short trades, these hedge trades without, if we're going to move higher throughout July, I want to be protected, and I don't want to miss any type of move, or at least not make any money through that period. But there's so many indicators that are getting just out of hand, and it feels to me like we're putting in a blow off top. But at the same time, I want to be a little hedged here, because this trend line break, the trend line that I've been talking about, we got it, and now we're bouncing right back up. And this could be the sign of a little bit of weakness. We've seen this type of thing happen before. I said with the Qs, I believe I said this in the video on Wall Street from Main Street, as soon as you broke this trend line, you kind of went up and back tested. And then again, you broke the pink one, went up and back tested. And, it's very, it's not uncommon. Look at NVIDIA. Back last year, you broke through this, then you made another high, we went right through it, and then you came right back down. So it's not uncommon for the first time that you break through a trend line for it to there be a knee-jerk panic buying reaction or a blow-off move before it moves lower. And that's very common, again, with like a rising wedge pattern like we see here on the Qs. If you look at the blue wedge, we're now above that, and we could see a little bit of a blow-off there. And again, I keep pointing out the similarities, but we saw the same thing with Bitcoin. You broke through this top side channel of the rising wedge, and then immediately you pretty much crashed lower, got a bit of a bid, and then rolled right over. So, but at the same time, I mean, the month of July it's notoriously a bullish month, especially going into the 4th of July weekend where we have that shortened trading week. So I just want to be careful here. But let's see. Yeah, oh, it's absolutely a short squeeze because, I mean, you look at what happened, you know, we talked about this last week. Is this down move just OPEX games or is it an actual move? It's clear now that it was OPEX games. I mean, you had the short squeeze immediately on Monday, and it really wasn't even a squeeze. It's just the same institutions that were shorting right here were shorting so that they could basically burn out all the calls that they didn't want to pay out on. And then they willingly squeezed themselves yesterday and today. So it's kind of just resuming that upturn from last week. Yeah, that's it probably wants to go up and test 10 bucks. It's going to have resistance at 9. But I mean, you got these series of higher lows in here. Is this like a Reddit name or something? It looks like one. I tend to stay away from these, but I did play AMC not that long ago. I got in at, I think I got in somewhere in this range here. I saw the higher lows, series of higher lows, and it jumped after hours, and I took like 10 or 11% on it, but I should have held it because, I mean, look what it did. But, I mean, like, I literally had like less than 0.25% of a position in this name, so. But yeah, just to answer your question, Econ. So you're right. It's about your. It's not about the money. It's about your strategy. So what I would say is, well, first of all, how long have you been trading for? But secondly, you're going to have to pay the market one way or another, right? Like, you got to pay your tuition. You can't be the top doctor in the country. I mean, how much does it cost to go to the best medical school in the country and get your doctorate? $200,000, $300,000? Oh, well, what makes you think you can just be an expert equity trader in a year or two? The best traders I know, including myself, and probably everybody in here, has blown up at least one account, probably twice, maybe 3 times. The average business owner fails 4 times before they're successful. So, I mean, this is not like you got to pay. It's like you're paying your tuition. So what I would recommend is just lower your position size, especially if it's your first year or two, and just learn that way. But 8 years, holy shit. Okay, well, I mean, sometimes you got to, like, Stanley Druckenmiller bought the top of the tech bubble. You know where Stanley Druckenmiller bought? Right here, an hour before the top. So it happens to all of us. But yeah, I mean, I think you got a decent chance of those IWM puts playing out. I like that you went out to June 2022 because you gave yourself some time. And the socks are pretty extended, but they're strong. But I mean, it all depends on what you want to do. You could, if that's all you have in those with that 35K, I mean, I'm guessing you just use that as like play around money or what? Yeah, it happens. It happens, man. So, like, the biggest mistake, I think when things started turning around for me is, and from a lot of traders I've talked to, is the minute you stop giving a shit about profit and loss, like, who cares about profit and loss? Just make the right trade. And what I mean by that is specifically lower your position size. Like, every position that you take, Like make that like 1% of your portfolio to start. And then if you want to add to it on a pullback or whatever, that's fine. But, and you might be like, oh, you know, I only, you know, if you have like some newer traders, they only have a $10,000 account. And you're like, but I'm only going to make like literally $20 on this trade if I, you know, if I make 10% on it. It's like, who cares? Do you want to make $20? Do you want to lose 200? And that's how you, and you'd be surprised how fast your account builds up when you just look at it that way. And stop, like, just forget about profit and loss. Who cares about profit and loss? Just make the right trade. You got, yeah, you got to pay the market. You got to pay the market. And, you know, you could pay the, you might end up paying the market $20,000. You might have, I know a guy who's a hedge fund manager, and he lost 15 grand his first year, 10 grand his second year, was break even his third year, and then his fourth year he made $5,000. And then from there he, you know, went up. But I mean, think about how long it took him just to get there. Now he's got his own hedge fund he's setting up this year. But before we get on too sidetracked on that, I want to point this out a little bit here. So we were talking about 2018, and you made me think of something. I think we're actually channeling 2007 a little bit more. So this kind of looks a little familiar to me. Like, you have the run up, February, March dip, then a run up all-time highs, June dip, another late June dip, and then a July rally. And then a jump into August. You got up to double top here, but I'm seeing more of a correlation with 2007. By the way, I think I posted this on Twitter a long time ago before anybody was following me, but, and again, with the bear porn crap, I know, but it's interesting to look at. Like, so you have this kind of like long period here, then a parabolic move, then another kind of 45-degree angle move, and then a blow off top and the NDX. And it's kind of the same thing here, just like longer term, similar moves. I just think that's interesting. But I think the IWM's cooked though. Like, I mean, yeah, maybe it makes a new nominal high, but again, it's parabolic like everything. And the SMH, yeah, remind me to like buy the semiconductors on like the next crash, because I mean, look at this. This is ridiculous. Like every time it goes down, it just has these massive moves. But semiconductors are in everything, and the world is increasingly more electrified, so to say. Yeah, that happens to you turn $124 into 15K. Yeah, that's happened to a lot of people too. Like they get kind of lucky in their first few months. Not to say they was your first few months, but like when they first start trading, you know, they make a lot of money really quickly, and then they think like, oh, like this is easy. And you're seeing that happen with a lot of the trader bros right now. Look what's happening to Dogecoin. Dogecoin's at 18 cents. But, you know, they don't understand like volume and float and all that sort of stuff that, you know, it literally takes one person to put in a market sell, and an equity like Dogecoin will dump completely. I think we all got effed on gold years ago. I really like Son of Gun. Do you have a Twitter handle? DM me on Twitter. But Yeah, I follow like I follow astrological cycles a lot. I'll have to look into that, but if you look into like even just like planetary cycles, like this right here, September 3rd, we had a Mars retrograde, and then that ended on November 3rd, and we had a Mercury retrograde in that time too. And it's just very like this sort of stuff matters, like new moons, full moon. We have a full moon Thursday, and this stuff does, you know, you wouldn't think it does, but I mean, our bodies are made up of like 80% or 2/3 water. And if the, you know, if the moon can affect the tide, it can affect our bodies, and it affects how we think. That's why you always have, like, you know, animals, like cats are always going crazy around full moons. But yeah, like these retrograde, now we're coming out of a retrograde today. That started on the 29th of May. So we'll see what happens there. My handle on Twitter is just my name, at Aaron Basile. Yeah, it's Justin. Have you ever tried averaging in on things? Like when a market's crashing like that, it's not a bad idea. But there are some equities that went to like absolute, like perfect. Like look at Nike here. I mean, like, tell me that's not the most perfect level right there. You got right to this pivot high at 60 bucks. You know, no, institutions didn't care that there was a pandemic. They're like, you're going to give me Nike for $60? Okay. I mean, they were buying it right here at 67, 68. And then, okay, yeah, you're going to give it to me for $68. And then it kept falling. Oh, you want to give it to me for 60? Yeah. And the guys with the real money to move on Wall Street are the funds who buy stuff for 20, 30 years in retirement funds and stuff like that. They got the real money because they're buying and holding for a long time. And when they see something like that, they're like, are you kidding me? They're going to defend that area because they were buying. You know, they were buying at this area. So they're going to defend those areas. You're not going to take a loss on that. What are you, nuts? Seasonal exactly like today is summer solstice. So that's an interesting. By the way, I'm 100% convinced. 100% convinced. Like, so we had this the spring equinox right here right here. We had this dip, and I was predicting this is going to be the beginning of the sell-off, and they the central banks, I'm 100% convinced they came in and they saved it. It was rolling over, and then they stopped it. Mysterious buyers just came out of nowhere. Same thing here on the 5th. It's so obvious. I mean, like, the PPT definitely is a thing. But yeah, I mean, like, that's how I come up with like my cycles. Partly how. If you guys remember the lumber thing here, like I said, like, yeah, there's a cycle top around probably the 3rd of May, and like lunar and you know, astrological cycles had something to do with that. I was early by a week, but hey, we got that nice pivot a week later, and then bam, 50. What did we lose? 50% over the next month. So I mean, like, this stuff, you know, I used to think it was a joke, but you know, it really is. It really does matter. But the moon cycles, usually with a new moon, it's if I remember correctly, usually the new moons are generally a little bit slightly to a bullish bias, and then like the full moon is the one that has a slight bearish bias. But they don't always play out. And eclipses matter too, for sure. $1,800 on Amazon. Yeah. Let's see where Amazon got. It definitely got to 1800. It was at eight. Are you sure? You're thinking 1800? Because this was March 2020. Are you sure you're not thinking of 1600? But I mean, those tech stocks just outperformed, you know. And there was insider buying. I mean, hell, the congressmen were doing that stuff. So I mean, like they knew, you know, that the Nasdaq was outperforming even during this crash. So yeah, $16. Yeah, yeah, 1600. Yeah. I'm really interested in what happens in August, though. I think late 2022, but I mean, you know, that would kind of coincide with what I was saying about 2007, right? Because 2007 was the peak, but the crash wasn't until September, October of 2008. I know I'm getting way ahead of myself here, but I like to think of these things. Yeah, I think it goes above that. Like, I think it's kind of a given at this point. Um, it's it's hard to say how much higher though. That's why I hedged long with Apple, because I just don't want to. I don't want to be stuck in, you know, a whole bunch of short positions or in any type situation like that if we have a July rally. I mean, I don't know. I think we could possibly. I'm actually better at projecting with the spiders here as a proxy for the QQQ. But if you look at this upsloping trend line here, wherever that goes to, I think that's like your max upside for the spiders. So we could go as high as maybe like 440 over the next month, but I think that would be kind of like a blow-off scenario. You'd have to really crank higher to get, you know, like let's take a look here actually. Let's just go to 20%. Yeah, so if we just extend this, yeah, I mean, so you can look at it for like 440 or so would be your max upside there before another pullback. But as far as the Qs, I don't know. It could be a situation where, like Bitcoin, you got above it and then kind of just rolled right over. But coming into the 4th of July, it's really tough. It's like out of the last like 30 years or something like that, we've had a dip in like late June, and then the week leading up to the 4th of July and like the week of the 4th of July have been positive, like almost like something like 29 out of the last 30 times. It's ridiculous. That's why I'm really careful about being short right now, and partly why I wanted to be hedged. But yeah, that, and I mean, look at the volume again. Like we had finally got some volume last week, and then look at this week. I mean, just dropped right off. So when you have light volume, it's definitely going to bode upside. NDQ. Is that on the? Are you talking about the composite or the actual Qs? Yeah, 14.5. The problem is there's really nothing wrong with this chart, other than it's like uber extended on the monthly time frame. $432, yeah. Best single bit of trading advice I've received. That's tough. I feel like I know exactly how to answer that, but I can't find the exact words. I guess basically the best advice I'll give you is that, like, forget profit and loss. Forget profit and like, so the trades that I've like lost the most amount of money on are the trades where I had the most conviction on, because I was like, oh, like I'm gonna make, I'm gonna turn the $700 into like $5,000 because I'm right. And I guess the best way to put it is treat all of your trades like equally, like no matter what your conviction is with them, and keep your position sizes small. So like the best way to look at it is, actually, here, I'll just quote Jesse Livermore for you. So how's that? Never put more than 10% of your position into one, or portfolio into one thing, and never take more than a 10% loss on any trade. So that way you're never risking more than 1% of your portfolio. Now that you can let it go over a little bit here and there, like if there's a specific level or whatnot, but that's one way to look at it. But one thing I do now is I try to I start with a 1% position on pretty much everything or less, unless it's something like Procter and Gamble, or like Walmart, some really low delta name where it's just a boring Dow stock. I have no problem going 4 or 5% on something like that to start off, because it's not going to go bankrupt, and it's not going to gap down 20% tomorrow or anything like that. And if you're only using 1% on a stock like Walmart, your returns probably aren't going to be that great. So you kind of need to, give it a little bit more. But generally, yeah, I just start really small, and you'd be surprised at how fast 1%, even if, on the AMC I was talking about earlier, I had literally like 0.25% of position in this, but I took 10% in a day, and I ran with it. Now, do I wish I had held it? Yeah, but who cares? Who cares? I made the right trade. I don't care about the profit. I don't care about the potential I could have. None of that matters. When you have 10% in a day, you take that. I mean, if you can do that every day, you'll be on an island within a year. Of course, it's probably not going to happen, but you get my point. You don't turn your nose up at those types of gains. Now, if you want to take 3/4 of position off and then trail your stop, I have no problem with that. But point being, just forget about profit and loss. Forget about, oh, I could make this much. Who cares about that? Just make the right trade, and don't put yourself at risk. NASDAQ monthly, yeah. The all-time. Scourge Watcher. So I would say if you just DM me on Twitter or send me an email, and I'll send you some links that can help you. But basically, W.D. Gann figured out all this stuff centuries ago. Well, no, it was a century ago, I should say. But he was a famous astrologer and a market technician, and he's absolutely brilliant genius. But yeah, he figured out a lot of this stuff. Oh, the hockey stick? Yeah. Yeah. And a good place for anyone to learn basic technical analysis. Actually, I'll just put it in the let's see. I'm going to put this in the comments here, because I get a lot of questions on this. But I think it's under here. Yeah, here we go. So basically just look under introduction, well, basically look under candlestick charts. And we have the fundamentals, that area there. Yeah. And, you know, somebody was saying on Twitter earlier, I wonder if Wall Street Bets will, like, start shorting, like, buying puts, basically gamma squeezing puts, and how hilarious that would be. And I'm like, well, you know what? If they really want to, quote unquote, stick it to the suits, the best way to do that would just be by VXX calls. Because, you know, the suits, they act like the suits like are these evil short sellers who just want to short everyone and screw the little guy over by like shorting the market. Let me tell you, the Wall Street hates short sellers. They hate them. Like, first of all, they can't make any money because who's going to buy their fund or like buy their financial product if there's a bear market? And firstly, secondly, but shorting only, the max gain is 100%. Whereas, you know, going long, you have an infinite upside. But, you know, everyone knows bears are made fun of on Wall Street. If you really want to stick it to the suits, buy VXX calls. I mean, that would just be ridiculous. And if they thought that GameStop and AMC was one-sided trades, then like just wait till you see leverage short vol. Just wait till you see the dollar. I mean, this is definitely a squeeze right here on the dollar. I got this fib here. I don't know if you guys saw this, but it's I put it on Twitter earlier, but just something to keep an eye on here. So the low from last week on the dollar took to the high. So we've basically just not even really kissed the 382 retrace on there. And if we look at the spiders, S&P, we've already eclipsed the 75% retrace of that from last week. So in other words, there's a bit of a divergence building here on the dollar index. So the dollar is holding up as the markets are basically recovering quickly. So that's something we got to watch here. Now, could this be nothing? Yeah, I mean, it was nothing the last several times the dollar's rallied. But the difference this time is we did something very special here. We closed above the 50 moving average on the weekly for the first time since May 2018. Or excuse me, May 2020, May 18th, 2020, excuse me. And granted, that doesn't necessarily mean anything. One close is not, you know, it's not the holy grail, but it's something. It's definitely something. Like, I think this is more than, I think this, you know, last week we did have quad witching OPEX, but they could have achieved what they did without running it that high. And that's why I'm kind of bearish gold right now, short term. I did dump my Agnico Eagle after hours, by the way. I don't like this bounce. I wanted to give it until at least Monday. I wanted to see what would happen because of OPEX, and we got a little bit of a bounce, but today, just look, it's very underwhelming. And we closed below this wide range green bar. I'm very cautious right now on gold. I don't like that move. And, you know, maybe that's signaling something to us with the equity markets. Maybe the dollar's telling us something. So, well, yeah. I had a buy signal on the dollar in May, and it didn't quite play out the way that I thought it was going to. what I'm seeing here, what I was seeing here is these higher lows. Actually, it wasn't even that. It was just these three right here, I think. Yeah, so it wasn't even that trend line. It was just these three higher lows here. And then we kind of took this low out. And then I was like, well, I don't know. I'm kind of neutral on it now. And maybe that was sort of the catalyst we needed. Maybe we needed the, you know, people to get bearish on it. Because there was a lot of people saying, hey, dollar can't hold 90 anymore. It's going lower. It's sort of a foregone conclusion, right? And then all of a sudden we get this rip your face off rally. So yeah, XLF, if anything, that's a leading indicator. Again, to go back to 2007. Yeah, there we go. Going back to 2007. So notice how XLF dipped in June, had a little bit of a bearish kind of bear flag here, dipped again, and then in July you had this mini little pop, and then it rolled right over. Well, if we compare it here, let's compare to the SPX. Notice how we had the dip in June, and then the SPX bounced, late June dip, and then SPX actually had a pretty robust bounce from June 26th up until the middle of July. But XLF was flat and underperforming. So XLF went from outperforming to underperforming. And you had this kind of crossover. I wonder what the Dow transports looked like then, actually. Yeah, similar kind of deal, right? Well, they performed about the same, I guess. But point is, XLF, I think, I mean, it could be a leading indicator. But it also could just be that the high yield trade is cooling off, and that's why XLF rolled over. And again, you know, you guys know that I pointed out, you know, is pointing out the transports and home builders for weeks. And I was saying, look, like there's something going on here. And then we got the, you know, the dip last week, but we'll see if it turns into anything. But when I see that, you know, the home builders outperforming for months, and then all of a sudden there's a massive reversal and they start underperforming, and the same thing with the transports. You know, then I have to raise some red flags up. But the transports are into some nice support. They did hit some nice support here on the weekly, as you can see. The 20 moving average, and you had this nice trend line here that it ran into. So they should get a bit of a bounce. But again, monthly chart. No, there's still a week or so left, but that's bearish. Like that's not like sugarcoat that. That's a bearish pattern. XLF. That's an engulfing reversal all day long. Still a week left, but that's not good. XLE. Again, another high yield play, so take it with a grain of salt. But look, you have this trend line breakdown, and now it's back testing it with the 50 moving average. So that's coming back in there. And you went straight up without consolidating. So, I mean, like, I don't like XLE over the next couple of months. What was the other one I pointed out earlier? We had financials. Let's see, hold on. XLE. XLE, XLF, well, either way. Not good look. Actually, it's going to bother me now. Copper, that's it. Yeah, this is a big one. Look at the monthly on copper. That does not look good. And every time these commodities go parabolic, look what happens. 2006 parabolic, what happened? And you try to make new high and then crash. And it went parabolic up until 2011. Look what happened. Corn. Parabolic, crash. Parabolic, crash. Parabolic, crash. Wheat. Parabolic, crash. Soy. Parabolic, crash. Parabolic, crash. So these commodities they're telling us something. Yeah, Jackson Hole's the pivot. Like that's what I have going on. That's where I have yields. That's a make or break for yields, honestly. Yeah, and FTX is pulled back into earnings. But you know, it's still holding up well. Home Depot, it's a pretty crazy chart. Look at this. That's ridiculous. But again, this is kind of like it was a stay-at-home play. Look at that topping tail, by the way. That's nice. Look at that. That's beautiful. Great pullback off of that. But again, these stay-at-home plays, though, you know. But what we're seeing is like sort of like a great rotation, right? It's like, you know, you get AMC, GME, you know, in January, and before that you had the high yield plays, the banks, you know, transports, energy, and then you had the meme stocks, and you had crypto, and then the money flowed out that, and then you had Dogecoin, the altcoins, and then the money flowed out of that, and then it was back to the meme stocks, and then it was back to financial. Now it's back to tech. Now techs are up front, so it's like there's all this liquidity, and it's got to find a home. And it's like these sectors are just like rotating over and over. And it's enough to keep the market higher for now. $17.60. Yeah. Yeah, if you take this pivot out on gold, that's not good. It's not good. I'm a little worried about it, not gonna lie. I mean, luckily I kept my Agnico Eagle position pretty small, so like I took a stop out on that, big deal. But when you have a bullish pattern like this fail, look at the one on Newmont. That's a clean bull flag, and that broke down pretty bad. Same thing on GDX, clean and broke down. That's usually a sign of trouble. If it can bounce by the end of the month, it's okay. I think they're safe. But if we look at a monthly chart of gold here, we've seen it happen before here. But and back here, we could be in this area right now. The only difference is this was sort of a back test of this breakout area, right? This candle. Well, we've already kind of back tested the breakout once. So if we were to go down and do it again, that would suggest that we're hitting this double bottom, which would be this, which would be obviously bearish long term. But I really don't. Despite that, I really do stand by my analysis from last week. I really think we are going higher long term. I mean, well, we have to, obviously, but I really think we are in this area. It just doesn't seem to make any sense that this would be the like we would go into another 10-year bear. It just doesn't. The amount of money that they're going to have to print to go into reverse repo and continue doing that, there's just no way. There's no way. Yeah. Yeah, 22, 24, yeah. Oh, just give me 1 second, guys. Just going to step out for 1 second here. Sorry, I just had to go pull something out of the oven real quick. But yeah, I mean the cup and handle's there. I mean it's obvious, but it's very hard to discount this price action. If it can pop back up on the monthly chart, and if you can close even just up in this range, 1825, 1830, it's probably going to be okay. But the fact that you got a bounce off the 20, you pierced the 20, and now you got this bounce, now you're retesting again already. It's not a good look. And I don't like this close below this green bar low here with good volume. And if it was just OPEX related, then we would have seen gold rally higher with the market. Like gold would already be up to 1840 or so. I mean, you got to remember, I just talked about the S&P's already retraced more than 75% of the downdraft from last week, and gold is barely off the lows. I mean, look at where gold is. Let's see. This was Friday, Thursday, Wednesday. Yeah, so yeah, gold's not even barely retraced 25% of the move from last week. So not happy with it. Yeah, I don't know what they're gonna like. They definitely can't raise rates now. And I guess you saw what the market did when they had Bullard floating the idea of raising rates sooner. But honestly, to me, that was just like, what's the word collusion is the word I'm looking for. Because they clearly just wanted the market lower so that they could collect premiums on OPEX Friday. Right? Because, I mean, the market just rebounded immediately today. So clearly this move was OPEX related. So they just utilized that headline from Bullard to push the market lower. But even if they were to raise rates, they'd have to do it in a way where it would take... Again, that's why they're like giving the market so much time. It's like, oh well, we might raise rates in like 2023. It's like 2 years away. Like, if we were any sort of healthy environment, that would not even be a big deal. But yeah, I mean, eventually they're going to get boxed in. But that's what they do. Bullard testing the market psyche. That's what they have to do. Like Yellen, this is why I'm telling you guys, rates are going to go higher. They do this stuff. They love job owning. It's the only thing they can do. It's the only thing they do good. When she says, like, when she comes out a week ago and Yellen says, rates going higher would be a good thing. It'd be a good thing for the market. That's her way of saying, hey, rates are going to go higher, and if you don't listen to me, it's your own fault if you lose money. So I mean, but they have to test the market's reaction so that they don't, 3 years away, yeah, exactly. Yeah. There was a Kevin, there was a Zero Hedge article on, I think it was like yesterday, I made a Reddit, or 2 days ago. It was about like how much of a mistake that, just the fact that their rate hikes in was it 2015 or whatever, like there was just no chance. Like, it was basically doomed to fail. It was doomed to fail. Like, the way that they set the system up based on easy money, not just based on easy money, but the economy in general. Like, obviously the equity markets are based on easy money, but it was going to get to a point where the economy in general just couldn't even handle those meager rate hikes, because that's what happens when you paper over a global financial crisis with trillions of dollars. Eventually, it's just you're literally you can paper over it, but it's kicking the can, and then you have to paper it again and paper it again. It's a you know, it's a losing battle. Yeah, they all think, they've actually convinced people, like, they convinced economists that inflation is a good thing. Inflation is a literal inefficiency in the market. A real free market is actually deflationary. PFIX. Not looking at prospectus, but initiate rate hedge. Without looking it up, what does this equity do? Interest rate hedge ETF. Oh, so, okay. But couldn't you realistically just buy TBT, though? I mean, it's a pretty new issue. Yeah, bet against bonds, yeah. It's got a super Peter Schiffy in it. Yeah, it did, yeah. Well, I know most of you guys found me through Jason, so like it was a matter of time before we got down that road. Econ dropout, send me an email or DM me or something on Twitter. I'll check it out. But I probably, you know, in regards to that though, I am looking to get into TBT though. We're just not quite the right time yet. And I'm actually, you know, now that we're on the subject and we've talked about it, I actually am expecting it to get the yields to get back to 1.3. I think that at this point, it's almost like I need it to be a contrarian play for it to work out. Like I want the headline on CNBC to, rates are down to sub 1.3. I almost need that before I get back in. But it's going to happen. Anyone else have any specific questions? I do want to do, so I asked, I think like a week or two ago, I talked about, like, because I had a lot of inquiries about, like, if I offer any courses or premium service, and like some of you guys said you were looking for like some type of course or something on like entry and exit prices and stuff like that. So, I mean, I do want to get some feedback from you. Like, if you guys are interested in some type of like premium content, I think that would probably be, I think I would probably be best about, or I would be best at doing like educational courses or webinars or something like that. So, I mean, that would be something I'm interested in. I could definitely do like entry exit prices, like portfolio management. I think that's super important. Nobody ever talks about that. You know, everyone wants to tell you how to read a chart or how to read a prospectus or how to analyze a PE ratio and stuff like that, but no one tells you how to manage your portfolio. And that's probably the biggest reason why traders fail, is because they might pick the right stocks, but they don't know how to manage their portfolio. So yeah, okay, so just, it's Aaron Basile at gmail.com if you need to email it. What does it mean when Head and Shoulders fails? So when any pattern fails, let me try and think of a good example. So here's a good example. Actually, you might be able to see it better on the E-mini. Yeah, there we go. So it's a small pattern, but this is, you can clearly see shoulder, head, shoulder, and then you had it trigger. It triggered right here, and it started to break down, and then you closed back above the neckline. So basically, all that means is whenever you have any type of failed pattern, more than 9 times out of 10, like 95 times out of 100, you're going to have a move in the opposite direction, like a robust move. So as you can see, this failed and then it ripped higher. Another really good example of one actually is in 2011 on the SPY. Look, I still have it right on here. Look at that. Oops. So notice how you had, well, this one played out perfectly. Perfect. Shoulder, head, shoulder. And I'll probably do a course, like this is something I want to do a course. I might even do just a video on this, even if it's just like a short YouTube video. But see how you had like this kind of shoulder, head, shoulder pattern? Just disregard this line here. So shoulder, head, shoulder, and then it triggered right here. But then you close back above the neckline. And then you did have a nice little flush here. And you had this other lower trend line, but then immediately what happens is you gap down and you close back above it. And then what happened? Huge move. Huge move. Huge move. So failed patterns generally give you the best moves. And that's why I brought that up with the GDX. This is still in play. This could easily be a fake out. You had the shoulder, head, shoulder, triggered, and you came back up and closed above it. And now we're back below it, but yeah, this one's tricky. I'm kind of like on a neutral, I'm neutral on GDX right now. Pretty much on gold in general, because now I have conflicting signals. Everything long-term is saying bull, 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 but at the same time, the short-term price action is so bearish that it's almost affecting the long-term structure. Another one that's very interesting to me is Peloton here. Like I almost consider just going long Peloton just because of this. Shoulder, head, shoulder, perfect neckline. This is the cleanest pattern you're ever going to see. Like you're not going to see a cleaner head and shoulders pattern than this. Broke down, and literally ever since that breakdown, you haven't had one lower low. It's just been all straight up. And this gap fill is actually minor because look at how much you consolidated. Yeah, Peloton's actually pretty strong right here. This is a strong stock. I'd consider going long on a pullback, honestly. In fact, if I had seen that sooner, I probably would have bought somewhere in this consolidation. This is a really strong name. Look at the volume. A lot of dumping, panic dumping, head and shoulders trigger, and then look at all the volume. Look at all the volume. Your average volume back here is 7-8 million shares. Look at how much volume you're trading here. Look at all these green candles. Look at that. That's institutional participation. So when you see those failed patterns, and this could be for anything. It doesn't have to be for head and shoulders. It could be for any type of failed pattern, right? Newmont, look at how tight and perfect that bull flag is. And boom. Down. Tesla. Strong move up. Choppy bullish consolidation. Broke down. Back tested it. These are actually fake print candles. But then you back tested it and you've gone lower ever since. Yeah, no problem, man. Yeah, shoot me a message on Twitter. Thanks for that. I think so. Upside for the dollar. I mean, yeah, 97 would be crazy. I think you're getting up to at least 94, 94.50 though. That's kind of maybe 95. That would be like my max move for like really this year, and you can see why. So you got the this low pivot here, 200 moving average, 100 moving average, this pivot, low pivot. So that's where that would be my max upside for the dollar, and then like next 4 to 6, 7 months or so. But unless there was like some type of crazy black swan or something like that. But yeah, that's going to be major resistance. This red bar too is pretty major resistance as well. Yeah, I think I just got your email, so I'll check that out. Will there be another division? I wish I knew that. I'll put it this way: I can see the potential for it, in the sense that when I'm talking about 2007, the similarities, and the long-term cycles that are in play. Yeah, I could definitely see like this being some type of a 2007 like volatile rolling top. Maybe we trade down and then we come back up and double top, and then 2022 is sort of a bear year with a major bottom being reached in like September 2022. Yeah, definitely based on long-term cycles, which I'm not going to get into right now, but definitely I could see it happening. To move high. Because the dollar and gold can sometimes move up with a positive correlation. Sometimes, like, in fact, we look at last year. So I'm predicting a bear market, right? Or like some type of a bear period at least. That would assume that the dollar is going to go higher and whatnot. Well, we saw the dollar trade up with gold right here, and even right here as well. They kind of had a positive correlation until the market settled, and then eventually they went back to negative correlation. So if there's, like I said, a potential for a bear phase, then that would mean that there's fear in the market, right? And when there's fear, gold does well and the dollar does well, because there's an exodus from equities, which means the demand for dollars increases, but also the demand for gold can increase as well. HYG, I saw man, I watched a video the other day on HYG. Let me see if I can. I'm trying to remember what I saw. I watched something on HYG, but I don't generally watch junk bonds, but I probably should watch it more. There's a video I saw, I think it was last night, on junk bonds, and I'm trying to remember who posted it. Or maybe I'll retweet it out later if I can find it. But no, I generally don't. But yeah, I probably should. Potential black swan. I mean, there's a lot of things going on with U.S., China, and Russia. Look at like the defense aerospace right now. It's climbing a pretty nice wall here. This is led by Boeing. So like these defense stocks and stuff are performing well. I mean, there's geopolitical tensions. Yeah, it's hard to say. That's because a black swan is a black swan for a reason, right? We don't know we don't know what it could be, but You know, we could theorize. I did say the other day that it was strange that all of the stay-at-home stocks like Peloton, if we looked at last week, the market was dumping. Peloton was higher, Zoom, DocuSign, Amazon, IGV, cloud software. Let's see, what else? It's another stay-at-home stock. I'm drawing a blank here, but you get the point. Yeah, the stay-at-home stocks were, you know, have been outperforming last week, especially as the market was dumping. So I mean, like, there's, you know, like, there's potential. Maybe the new Delta variant is going to be turning into something. You know, Cisco. No, Cisco actually dumped out. So it could just be tech moving higher, but yeah, ARK. I mean, although ARK, I think if there's something you want to short, this is it. And it's actually right into the sweet spot, honestly. Get that 100 moving average right there. Got through gap fill. No longer care about, but you're retesting this trend line. And on the weekly, look at that. So you're coming into this red bar high. Again, this thing is going to perform with Tesla because she owns so much Tesla. But this is a soft chart, man. Tesla's soft right now. And you look at the other stay-at-home stock. Netflix is getting a bid. Today it got a nice little bid, but it was getting a bid last week when the market was down. That's what I was thinking of. But anyways, looking at FANG, so Tesla, not very good on the weekly chart. Not very good on the daily chart. Well, what about the other FANG stocks? NVIDIA, all-time highs. Google, all-time highs. Microsoft, all-time highs. Amazon, pushing all-time highs. Facebook, all-time high. Apple, a little softer, but pushing higher now through this topside trend line. So Tesla's soft, man. Tesla's really soft. Look at NIO. NIO's still holding up well. Like, I thought this thing was going to crash back down to 20 bucks. And it probably will eventually, just because I mean, this thing was basically a bankrupt stock before the pandemic. But Tesla's got a lot of competition. Kia is partnering with Apple, GM. They're all making electric vehicles now. And with Tesla, or with Bitcoin going down to 30K, I mean, yeah, they almost lost more money on Bitcoin than they do selling cars. Yeah, Adobe, yeah. Did Teladoc bounce? Teladoc's probably due for a bounce, man. Yeah, it's holding up, but this is nothing to get excited about. I picked this up a while ago on the crash, on this 200 moving average hit, and I think I dumped it for like a really small gain. I did not like what it was doing, but so that was lucky. But yeah, this thing's kind of like a dog with fleas, honestly. It should hold this level for at least now. Oh, it's going below 550. It will. But yeah, that's how you simplify the charts too. I like that. I like that level you're talking about. All you got to do is just look. Does it make a lower and low? And if it does that, then that's how I found how I predicted the top in Bitcoin, really. Higher, low, all-time highs. It's hitting all-time highs every day. How do you know if it's going to be in a corrective phase? You just wait for it to make a lower low. And as soon as it did that, I said, hey, it's now vulnerable to a correction. And then I pointed out, like, hey, this is like an MA pattern, head and shoulders pattern, whatever you want to call it. And sure enough, a couple weeks later, it rolls right over. Yeah, Michael Burry, man, jeez. It's like, and it's confusing listening to all these different, like, gurus and sources. It's like, one part of me is like, we're like on the cusp of hyperinflation, and then like another part of me is saying like we're about to hit a major disinflationary period. But I mean, he called like a generational top in 2008. Can he do it again? Maybe. Obviously, he's a smart guy. But I think in the short term, at least, the inflation crate's a little overcrowded. That's why we're seeing, these commodity prices come in so hard. Copper came in pretty nicely. It's got to hold this $4 area. If it loses $4, it's really vulnerable. I mean, like, yeah, it's got a nice base here at 360, 370, but that's a pretty big correction. And it's got a decent base around 3 to 3.2, but again, going back to this monthly chart, that's not like, they're in no way, shape, or form is that bullish. I mean, like, that's as bearish of a reversal candle as you can possibly get, especially considering the previous month you left this nasty tail right into double top after making an all-time high. Now it's still got a week or so left before the end of the month, but that's not a good look. So, but yeah, does anybody else have any specific questions? I'll answer them, and then we'll get out of here. Let you guys go. Yeah, thank you, Kevin. I mean, I love doing this, so it doesn't bother me at all. If I wasn't doing this, I'd just be poring over charts anyway, so. Yeah, absolutely, guys. All right. So yeah, I think I'll get out of here. Yeah, again, just watch the, I think like what I'm going to really watch for this month is put call. Just to wrap up here. Oops. Yeah, just watch this put call ratio. We get lower than that 0.33, 0.34. I'd really like to see it get to 0.32. And if we can get a flush lower in the VIX, yeah, we get to that area, that's where I think volatility is primed to make an actual move. Because every move we've had so far has been kind of just like a bit of a preview. We've had these little dips, but obviously that's not what we've been looking for. So, but yeah, anyway, guys, thank you guys for hanging out with me tonight. And I see some of you guys already sent me emails. I'll check those. And if you guys have any questions, you can DM me on Twitter or my email. Should be posted below. But yeah, anyway, guys, thanks. We'll see you later.